Hello everyone, this is the trading team at Trade Oxygen here. Welcome to another post-market analysis. So this is for the Thursday, 3rd of October 2024 for micro E-mini NASDAQ index futures. So let's see how things went on the day. So if you haven't looked the pre-market analysis for the same day, we recommend you to pause this video and go and have a look at the pre-market analysis where we gave 3 scenarios and all 3 scenarios played well, and then you can get a clear idea of the post-market analysis to see how the things went during the day. So have a look at that video and come back to this. We recommend that. So during the day we had some high impact news. So there were volatility in the market due to the news at 8:30 and 10. So we need volatility to trade, which is good. So to start with the charts, when we had a look at the 4-hour chart, we noticed that the market made, let's say, a swing high and a swing low, and then there was some range build up here, range of orders, and then this swing leg over here, and then the price coming down. So in this swing, if we look at this part again, because there was a range here, and then this price leg over here broke the range, broke the highs of this swing high was broken here. So if we look at that swing leg, and then when we see the price coming down, this bearish candle coming down all the way, right, that was okay. So over here it's a break of structure, because the market was going higher high, let's say from here to here, and a retracement, and then let's say a range build up likewise. Okay, and with that, if you look here, and you can see this swing high. Okay, let me do it this way. So this swing high over here is broken here. So the market was having making higher highs. That means, let's say, bullish in this part. But then over here, when the price came down and when the price broke this swing low, let's say you can consider this one or this one. The idea is for us to see that there was a break of structure. So we can see when the price go down this swing low, we can see a break of structure down. So when we see a break of structure down, which means the price was bullish, so now with the break of structure, this displacement candle, now current situation scenario was the 4-hour is bearish because of the break of structure down. So because of that, we were looking for 4-hour bias was bearish. So when we came to the day, we had a bearish 4-hour bias. So that was the higher time frame for the day for us, which means we were looking mainly for short entries. However, we gave 3 possible scenarios in the pre-market analysis and all 3 played well. Let's have a look at that. And then with the bearish 4-hour bias, meaning the daily bias was bearish for us, then we went to the 1-hour chart. This is that price action we draw. So then we were looking at this price leg in the 1-hour chart. And in the pre-market analysis, we mentioned that this price swing is significant from here to here down. Okay, so from here to here, it's a significant price swing, and there's a 15-minute fair value gap. And then we can see there's relatively equal highs being formed over here. I mean, from here to here, if you, okay, let me put it this way. So there were relatively equal highs formed. Okay, let me put it that way. So there were relatively equal highs. Okay, so the idea was, if I just further bring it a little bit towards this side. So the idea is, okay, over here with this footprint, meaning the 1 hour uh, displacement down and the price retracing, and during the retracement price making relatively equal highs. So this relatively equal highs over here gave us buy side liquidity to stay above this relatively equal highs. So above this there's buy side liquidity. So in the pre-market analysis we mentioned that this was the day, Thursday. This is the price action for the Thursday. So in the pre-market analysis we mentioned a couple of things. One is the fib retracement. So this price leg, when we draw the fib from here to here, down here, we notice that in the retracement, during the retracement, the price reached 50% of the fib. Okay, so let's bring it like a little bit towards this side. Okay, so what we meant in the pre-market analysis, we said that in the retracement, the price reached 50%, and if you look in another angle, you can also think like this with a slight variation, right? So if you look at that, we notice that the price came very close to the 50%, and then it went slightly above 50% during the retracement, and it made relatively equal highs. And above that there's 15-minute fair value gap. So in the pre-market analysis we mentioned the possibility. Have a look at the pre-market analysis at 9:30. Before the market started, we said there's a chance of price coming and grabbing this buy side liquidity and coming like a magnet to the fair value gap. So as you can see, it happened, right? So then if you are not sure why there's buy side liquidity here, what's the fair value gap, why we mentioned the price is going to come here into the fair value gap as a magnet, and also we mentioned that okay, the price is at a discount, so the chance of price coming to the premium. If you are not sure about those terms, don't worry, subscribe to the channel, click the bell icon. We will release more videos in the very near future explaining each and every topic separately. Okay, so what happened was, as we said in the pre-market analysis, what happened was the price was at a discount because it was below the 50% of the fib. So price acts like a magnet, and how price works is it goes from premium to discount, in this case discount to premium, or from here the price went, let's say price was going from a premium to discount, and then price is acting like a magnet where the price will come to imbalances like fair value gaps. So that is to rebalance the imbalances. So due to that the price came to the fair value gap. So we said that this is, so because of that we said one possible trade at 9:30 was to take a trade here, a buy entry targeting to take profits over here. But then we said it's counter trend because 4-hour, as we said little while ago, 4-hour bias is bearish. So if you took this, we said it has to be a quick trade, right? And then we said after the price in the pre-market analysis at 9:30, we said if the price comes here, then we said there's another trade opportunity. We said there's another trade opportunity for you to take a trade here and go down, take profits. So that was the second trade, possible second trade, what we mentioned in the pre-market analysis. So that also went well. So there were two trades, and we said there's a third trade as well that you can have a look at the 15-minute chart. So with this understanding, now if we go to the 15-minute chart, okay, if I take you to the 15-minute chart, so looking at the 15-minute chart, this over here was the first trade, and over here was the second trade. This one counter trend, quick one. This one is this. So this one is a buy entry over here. This one will be a sell entry over here. The sell entry is in line of our 4-hour daily bias, bearish. So the high probability trade was this one over here, right? Okay. Now in this we can see price action. We mentioned about a third trade idea, but we said that's a scalp. That was the trade from here to here. Look at the pre-market analysis to understand why we said there was a trade here, but that was a very quick scalp. The two major trades were this one, the one over here. Okay, so that in terms of a trade idea, if I bring this arrow down here, the trade idea was from here to here. Okay. Uh, Again, why this was a trade? We explained that in the pre-market analysis. Okay, so what happened at 9:30? At 9:30, when the market started, uh, the price was here. And we can see in the 15 minute there was a huge displacement towards up. Now, we were expecting the price to go up like a magnet to the fair value gap. So, was this a place to buy? Well, because we were expecting the price to go to the fair value gap, and if you look at, let's say, a fib retracement from here to here temporarily, you can see the price came to the fib 62 and 70, that area. So that means this can be considered as an optimal OTE, optimal trade entry based on ICT concepts. If you're not sure what that is, what is OTE, we'll release videos, so subscribe to the channel. So based on OT, optimal trade entry, there was one entry here. Not only that, then also looking at this price leg in the 15 minute, because we are expecting the price to go to the fair value gap. Based on that also, if you draw, you can see in that fib also the price came to look, these are the fib values to 70%. That is an also optimal trade entry looking at this price leg. So we had a optimal trade entry option there. However, keep in mind, we just don't take the trade based on the OT only. We had a bias, like a counter trend bias from here to here, meaning we had a bias of price going like a magnet to the fair value gap. Of course, it's counter trend, but the price acts like a magnet. So we said there's a trade, but we said it has to be a quick trade. And the OTE, optimal trade entry, suggests there's a trade. So one could have taken a trade here. Now let's see, did we take that trade at trader oxygen? Okay. Let's quickly go to the 5-minute chart to see if we if we took that trade. So this is the 1-minute chart. So at that time we went to the 1 minute, 5 minutes and 1 minute charts. And if you look at the 5-minute chart, you will notice that in the 5-minute chart, there was a displacement at 9:30 happening up. So we need displacement to take a trade. So we saw one criteria to suggesting there's a trade here. And then we went to the 1-minute charts, right? We went to the 1-minute chart to get a more detailed look at the price. And over there, in the 1-minute chart, we noticed that, okay, this is that displacement. Then we were looking for a couple of things, like for the footprint, we were looking for a few things. Let me look at that. So in the 1 minute, when we saw the displacement happening here, so that was one criteria for us. But then, okay, did the displacement take a swing high? Yes, it took a swing high. Why are we looking for that? Because what we want is, if you look at this drawing here, we want, in a situation like this, what we are looking for is, okay, the price was coming down, see this area, like making lower lows and lower highs. And then what we are looking here in this displacement is, this leg is for the price to take out a previous swing high. So that is what the price action we are looking. So that is what happened here. So the price, this displacement took the previous swing high, okay, over here. So after it takes previous swing high, then what we are looking for is for the price to retrace back into a fair value gap. So during this displacement, meaning this one, we are looking for a fair imbalance like fair value gap, and also we are looking for an order block to be here. So we can see the order block has formed, and also we can see in the price leg there were some minor fair value gaps. For example, between this candle and this candle you can see a fair value gap. Again, if you are not sure why this price action, why we are looking for this and why order block and fair value gaps, don't worry, we understand it's a lot of concepts for you, it's overwhelming, but subscribe to the channel, click the bell icon. We will release videos one by one explaining all of this in a order. For the moment, what we want you all to do is to feel that how we analyze the markets, and it's to see that it's done with sound logic. So we saw a fair value gap. Then what we expect is, when we see a fair value gap, what we expect is, if I just keep this line, we can see another fair value gap here where I move my mouse. So this is 1 minute. So when we notice these fair value gaps, okay, so we are expecting the price to come into this 5 minute, this 1 minute fair value gap. So one was there, then the other one was here, okay, like this over here, right? Okay, so we are expecting the price, okay, if I just delete this, we are expecting the price to come into a fair value gap and an order block. So the order block is here, then the fair value gaps are here. So we were now expecting the price to come down. Did the price come down? Yes, it came down a bit. Yes, it tapped the first fair value gap, right? Then could we take this trade, right? Could we take? So if want to take that trade, like in this fair value gap, then what you have to do is, right, you have to look, if you have to place a long entry here, considering the top at the fair value gap. However, then we have to place a stop loss, and we have to see if the take profit range is sufficient enough, right? We have to look into those aspects. So in a situation like this, when you have like more than one fair value gap, we have to anticipate the price, that we have to expect the price, a chance where price could come down as well. So we have to put the stop loss covering that as well. So there's a particular theory behind how you can put the stop loss. So we will release more videos on that. However, if you are to place a stop loss here, for example over here, well, covering this fair value gap, but then giving allowance for the price to come down, one option was, let's say, at least a midpoint of the order block. The other option was putting the stop loss just below the candle which formed this fair value gap. So those are theories, don't worry. Subscribe to the channel, you will get more videos on them. But all this, if you see, suggest the the risk to reward of the trade will be 1 to 1.5, because we have to target at least partials taken in a near swing high over here. So there's sound logic here, right? Okay, so we'll release more videos on those. So if we target that, then what we notice is the risk to reward is not enough in this trade. We are looking for at least 1 to 2 minimum risk to reward. If we risk 1%, we want a profit of at least 2%. In that case, this was not the trade. We did not place a trade here. If the trade was here, it would trigger, and of course it will be a winning trade. The price will pass that as well. As you can see, if we took the trade, the price will go all the way up. However, price can do whatever it like. It might not go all the way up. Yes, in this day it went all the way up, but it can, let's say, go and take the liquidity over here, and it might all of a sudden go down. So we can't. So we have to be systematic in taking a trade. We have to see at least can we take some partials at this point to us to at least retain some profits, and if we don't see that, we don't take the trade. Then you might say, well, the trade went well. Yeah, it went well like this, but on another day, instead of going up, it can go down like this, like we mentioned. So we have to take this. So as traders, we take systematic decisions. So at the trading team at Trade Oxygen has sound logic behind the trades we take. So because of that, we did not take this trade, and we put a limit order below this. I will show that entry. So this is the trade we placed as a limit order, at least which has 1 to 2 risk to reward. However, as you can see, the price did not come and trigger our trade. So if the price came and triggered the trade, we will be on the trade and we will be profitable. So we missed that opportunity. When I say we missed that opportunity, what I mean is the price did not give us that opportunity. It's not that we missed, it's that the price did not give the opportunity. So as traders, we have to take the opportunities given by the price systematically, right? So this was a trade, possible trade, but it did not, the price did not come to that. So because of that, we did not take the trade. We missed the trade. And then the next trade was, as we said, when the price reached the fair value gap over here, see the price came, after we missed that trade, price came making higher highs into this. And the moment the price hit the fair value gap, you can see there was a huge displacement down, right? So this is significant, this displacement, and you can see in this displacement, it makes some internal market structure shifts down, like let me show it to you. So in this you can see it made a market structure shift, internal market structure shift down because the price was making higher highs, then a displacement, and then the displacement broke this swing low and this swing low. That is a market structure shift. That is what we are looking here. Before we take a trade, we are looking for an internal market structure shift with a displacement and to see if there's a fair value gap. You can see this is a fair value gap over here, order block, and then we can see a huge fair value gap. So those were the uh, characteristics we were looking. So when we see market structure shifts, when we see the order block here, and when we see the fair value gap, then we place our limit order over there. If you're not sure about this concept, subscribe to the channel. We will provide you more details with simple videos, right? And then we placed another trade entry. Okay, over here. This, not that, that was another one. Okay, this one over here. That trade was this one. So we accumulated more positions. That is based on, okay, after this swing market structure shift, the price came and it rebalanced this imbalance. So when the price come and rebalance an imbalance, it becomes a this becomes an intermediate term high. So when it forms intermediate term high, rebalancing a fair value gap, we expect the price to respect that intermediate term high because it's bouncing from a fair value gap. So because of that, and when the price break down, then this is another possible price leg down. And then when the price retrace that, because we now expect the price to respect this intermediate term high, and we can see order block here. So then we expect the price to respect at least the midpoint of the order block, halfway in the midpoint. So based on that, we place another trade entry, and coincidentally that also is in the tip of the price over here, because it's not that we are putting it exactly in the tip, it's just that coincidentally it's fitting into 1 to 2 risk to reward, like where we, for example, if we put it down like this, it's not 1 to 2 if you see the risk to reward. So when we move it and look for a position where it gives at least 1 to 2 for us to take profits, coincidentally it fits this. So that's the beauty of price action. And so these were the trades for the day. I hope you got some insights from this post market analysis. Subscribe to the channel, click the bell icon. If you are not sure about these concepts, we'll release simple videos for you to get an idea. So we will meet you with another video again today with another pre-market analysis for the Friday. Until that, stay safe. We'll see you later.